Okay, Josh, I think we're going to kick off. You can message me too if there's something I can do on my side to fix the audio. Is it okay? Okay, good. Okay, guys, financial statement analysis. Welcome. I sent you guys over the reading, which was quite long and complex. And quite frankly, not everything in it was totally relevant. I think the most relevant section was section 4, which talked about the different parts of, or the different types of ratios and kind of how to calculate them. This cat is just, I hope you guys don't mind my cat attending. I thought what I would do today actually was just to kick off with going through, picking up the exercise I worked on last week. And I've neatened it up a bit and added one or two things that I just wanted to go through with you guys, and then after that jump into ratio analysis, if that makes sense. Okay, I'm going to just post a link in the chat here to the problem set. Well, it's not really a problem set, it's just an example that we'll work through together. So if you guys can all just grab that and then let me know if that opens up for you. Okay, I'm going to go ahead and share my screen. Okay, can everyone see the screen?
Yep.
Nice haircut, by the way, Francis.
Thank you.
I need to go for one myself. Okay, guys, are the numbers big enough to see, I presume, or should I enlarge it?
I think it's okay.
There we go. I think I can hear you guys now.
Hey, Josh.
How's it going?
Good. Do you want to just give us a quick intro? I was just saying Jay has just joined us. He's down in Florida. And this is Josh. Josh, introduce yourself real quick.
Sure. So I'm from Whitby, Ontario, which is about a half hour outside of Toronto. I go to school at Wilfrid Laurier University, which is in Waterloo, Ontario. Again, just outside, probably about an hour and a half, 2 hours outside of Toronto. I'm in for a BBA program, and I'm specializing in finance, and then I have a minor in economics. As well, I'm trying to work around possibly getting a CPA, CFA out of that as well. So that's kind of on the financial side. I'm doing a bunch of other courses and whatnot, just to try and get ahead. And I'm currently in a finance co-op job, basically as a financial analyst, kind of going around all the different departments and stuff. So I took last year off school. I did some infantry officer training with the Canadian Armed Forces, which is pretty cool. And I've been playing professional music since I was 13. Big recap of myself. So
thanks, Josh.
Yeah, no worries.
Okay. Okay, guys. So this is essentially the same scenario. Last week, Danger pointed out that there was a problem with the way that I was pulling, I think, either accounts payable or accounts receivable into the balance sheet. And that problem is still in last week's model. So I fixed it in this week's model. So use this week's model if you want to understand the workings of the problem. And in addition, what I've done is I've gone and I've color-coded all the hard-coded inputs in yellow. Okay, so you can see what's a hard-coded input, and then everything else has got formulas that you can sort of follow back through. So just as a quick recap, we had a scenario where we had a company that had the other thing I changed, guys, last week it was month 1 and month 2. So I've just changed it to year 1 and year 2, because otherwise our ratios that we calculate don't look sensible. So just, we need to just imagine that it's the months have expanded into years. So we had sales for 2 months, we had selling price, we had the purchase price of the inventory. From that, we backed out the cost of inventory expense, including how much was purchased. And we worked out the accounts receivable. We had some vehicles which were being depreciated. We had some accounts payable. And then from there, we filled out the income statement, the balance sheet, and the cash flow statement. Okay. What I wanted to add today was firstly to explain to you guys what is this thing of EBITDA. Okay, EBITDA stands for, and I'll start off over here on the income statement. So EBITDA stands for earnings before interest, tax, depreciation, and amortization. Okay, so last week we had some depreciation in our fixed assets. We had fixed assets that were acquired for $10,000 3 years ago, and therefore at the beginning of this year there was $6,000 remaining. And this actually should be changed because this is still the monthly depreciation. So that should be the annual depreciation. So it doesn't kind of make sense, but anyway, it's depreciation. Don't worry about that. And so we've got depreciation in each year and then the closing balance of the asset, right? That's our depreciation. In our income statement, that depreciation is included, okay? It's included in SG&A on the face of the income statement. Okay, it's included in SG&A, and you can see if you look at the formula that it's a semi hard-coded number. So we've pulled the depreciation into this SG&A line, and then the rest of the SG&A we've just made up numbers. Okay, so the depreciation is included, okay, in the SG&A. Okay, why is this important? This is important because if we're trying to work out earnings before interest, tax, depreciation, and amortization, we start out with the net profit, right? This number here, 8243 at the bottom of the income statement, okay? Then we need to add back the stuff that has been subtracted off in the income statement, okay, that we don't want to be subtracted off, okay, because we want earnings before interest, tax, depreciation, and amortization. So if we're starting with the bottom, after everything subtracted off, okay, which is here, same numbers here, we need to add back interest. We need to add back tax. Okay, and we need to add back depreciation. Okay, depreciation, we're picking it up from the asset recon here, but it's actually included in this SG&A line as well. And that's why we're adding it back. Okay, that's what EBITDA is. Okay, any questions on that? Earnings before interest, tax, depreciation, and amortization.
Would we want earnings before all that instead of like earnings in general?
Okay, Dagger, excellent question. Okay, the reason that this number is important is because it's a proxy for cash flow. Okay, because if you think about it, depreciation is not an expense which is paid in cash. Do you agree?
Mm-hmm. Okay,
now when I say proxy, so that's why, right? So that's why we're adding it back. Okay. And the other reason, so it's supposed to be a proxy for kind of the operating cash flow of the business. Because if we purchase a business, for example, we might purchase the assets and the operations, and then we may change the financial structure of the business. We may introduce additional leverage. Okay, and then as a consequence, the interest and the tax for us as the purchaser of the business are going to be different. Okay, so that's why we want to start with EBITDA. again, it's a proxy for cash flow and it's a proxy for operations, okay? It's not a perfect proxy because there's certain items, for example, I'm going to have to explain this actually more when I get to the cash flow statement partially, but some of it you can understand from here. Say, for example, you purchase a fixed asset. You purchase a new vehicle, okay? That is not anywhere in the income statement, and it's also not in depreciation. It is in depreciation to the extent of the depreciation, but let's say we buy $1,000 asset, depreciation is $100 a year, okay? It's not the major part of the asset purchase, the depreciation, number one, and number two, we're adding it back. So we're going to land up with EBITDA that ignores the asset purchase cash flow. Okay, so it's not a perfect proxy, but it's a useful proxy, okay? And then it's used often in private company M&A as a valuation metric. So kind of companies we're looking at are usually bought for between 4 and 6 times EBITDA. And that's how the business brokers and M&A guys price them. Okay, actually it's not exactly true because there's further adjustments. Okay, but we'll get into that later. But it's EBITDA, okay?
Actually, I have a question, Daniel.
Yes.
In SG&A, why are we including depreciation?
I just included it there because I like to keep my income statements as the face of the income statement, like quite simple. Okay. And then to have notes breaking stuff down. Like you could split it out separately and have a separate line called depreciation. You totally could.
Okay.
Depending on what the company's, I think that's really the best answer there.
Okay.
Okay, the tax numbers, guys, I made up the tax numbers. Okay, I just made them up. We're not going to probably get into tax at all, or if we do, it'll be later. Okay, so the other thing that I added to our little model is a term loan. Okay, a term loan is a bank loan. Okay, our term loan, we've made up an opening balance of $5,000. We've made up an interest rate of 7%, and we've made up that we're paying $750 of it per year. Okay, so from these made up assumptions, what can we back out? Well, the first thing is what's the interest that we pay per year? Okay. The interest in the first year is going to be 7%, the interest rate, times the opening balance of the loan. Okay, just like if you've got a car loan, you bought a car, the opening balance of your car loan times the interest rate, that's going to be your interest, okay? Your interest expense. Okay. However, you've agreed to pay the bank back $750 a year. Okay, which is more than the interest because you're paying some capital off, isn't it? Same as your car loan. The balance goes down because you pay more than the interest, you pay a bit of the capital too. Okay, and so if we want to see what is the balance of the loan at the end of the year, we say, what was the opening balance? Okay, plus we owe more because we owe the interest, minus how much we paid, okay, equals the closing balance. Any questions on that? Okay. That's quite logical, that one. Okay, and then the following year's opening balance is the previous year's closing balance. Again, times the interest rate. It's not the same. The interest is not the same because the opening balance has gone down because we paid more than the interest. So we paid off some capital. So opening balance times the interest rate minus the payment amount gives us the closing balance. If we want to know how much capital did we repay, it's the difference between the total we paid and the interest. Okay, difference between the total we paid and the interest. And also you can see the way this all works out the balance went down by 400. Okay, the balance went down by 400, which is the amount of the capital repaid. Okay, that's the loan. Okay, so how do we fit this in, right? To our financials. The income statement is the interest. Okay, that's where it goes. The income statement doesn't have, okay, it doesn't have the full payment. It doesn't have the capital portion of the payment. Only the interest portion goes in the income statement, okay? That's the amount that we recognize as an expense for the purpose of accounting. Okay, so back to what we were discussing earlier about EBITDA, okay? The problem, another problem with EBITDA is it doesn't give us the capital that we paid on the debt. It doesn't, right? Because it just doesn't take that into account. Right. Lastly, before we move on to ratio analysis, okay? Last week we did our cash flow statements under what's called the direct method. Okay, under the direct method, okay, that we did last week, we had cash received from customers. Okay, remember that was, we said how much was our revenue, and then we said what was the movement in our accounts receivable equals cash received from customers. Okay, how much cash did we pay to our suppliers? We worked that out from accounts payable, right? From payments. Okay. The way that I've done it here is okay, now this is going to be confusing as hell. Okay. How much cash did we pay to suppliers? Okay, it should be suppliers and employees. Okay. Okay. We paid for purchases of goods, but we also had other expenses here in SG&A, right? We had rent, we had overheads, we had, various other stuff that we paid, right? However, okay, some of that in SG&A is depreciation, okay, and that is not something that we paid in cash. So the amount of this SG&A that we paid in cash is the difference between the total SG&A, okay, and the portion that is depreciation. Okay, and therefore, cash paid to suppliers and employees, okay, we're saying payments calculated from the accounts payable, okay, plus the difference between SG&A and depreciation. Okay. Don't worry about it too much, guys. Don't worry about it. Operating cash flow is the difference between received and paid. Okay, then, okay, this is just the traditional way that we break these things down. So we usually put the interest portion of the loan payment up here, okay, and we put the capital portion down here under financing cash flows. We split it. Tax usually goes up here. There's some, you can choose to an extent, but this is the way I've done it. And then the cash movement for the year, cash at the beginning of the year and cash at the end of the year. That's what we did last week. Okay, guys. Now, who can tell me something that they can see on this cash flow statement that is surprising? Okay, this business is burning cash. Okay, this business is burning cash. The movement in cash for the year, here it is, right? This business is burning cash. However, the income statement shows that it's actually making a profit. And the difference, the important thing to know, guys, is that the income statement, it's prepared on an accounting basis. It's not on a cash basis. Okay, last bit of vastly confusing information before we jump into ratio analysis, which is much more logical. There's another way to calculate this operating cash flow. Okay, operating cash flow. There's another way to calculate it. The way to do it is you start off with EBITDA. Okay, then you work out a number called the change in working capital. Okay. And the change of working capital, okay, it comprises three things. The change in inventory, the change in accounts receivable, and the change in accounts payable. If you guys recall, working capital means accounts receivable, accounts payable, and inventory. Okay, so what happens if our inventory decreases? Okay, let me make it easier. What happens if our inventory, what happens to our cash flow if our inventory increases?
If our inventory increases, cash flow would decrease?
Correct. Correct, because we're buying more inventory. We're exchanging cash for inventory. Okay. What happens if our accounts receivable increases?
You have more cash.
Actually, no.
Well, then when all the payments transfer, you have more cash.
Yeah, but before then, so right now, your cash
It
decreases.
doesn't show up. Yeah.
Decreases
Your assets
because,
would increase.
that's right, yeah. So people owe you more. If accounts receivable increase, people owe you more. Therefore, you have less cash. Because you lent it to them effectively. I mean, it's not a loan, but that's what it is. Okay. Accounts payable. Okay. What happens if accounts payable decreases? You can see it on here. You can see it's a cash outflow of 150, but let's try and understand the logic. What happens if accounts payable, the amount that we owed increased? Think of it like this. You have a car loan. Okay. The amount that you owe on your car loan decreased. What happened? You paid, isn't it? You paid. So it's a cash outflow. Okay, so you take those together and you get this change in working capital. So you start off with EBITDA. You take the change in working capital and you've got operating cash flow. This 367. You see that? That 367, you can see it's the same number up here. This is called the indirect method of cash flow statement. And it's the method that we're actually going to use when we do financial modeling and valuations and et cetera, et cetera. Right. Okay. Any questions on that, guys? No. I have to admit, I mean, you know, when I studied accounting, I sat there, I didn't know what they were talking about. I had no idea. And the way that I passed my exams is I just got the previous exam papers. And I just practiced them. I honestly, I don't know what to tell you. It's just, it doesn't make any sense, accounting. You just have to practice. Okay. Good. Ratio analysis. Okay, guys. Okay. So, guys, who can tell me, why do we do ratio analysis? Why might we? There are a couple of reasons. Can someone give me a reason why we might do ratio analysis?
To use against public comparables.
Say a bit more.
Like comps for different companies, essentially, just like comparing one company to another in terms of like not necessarily their overall size, but just in terms of the internal financials, I guess.
Absolutely, yeah. Comparing one company to another. Okay, comparing one company to another. That's a big reason. Why might we want to compare one company to another?
Could be understanding like general industry.
Yeah. To understand the industry, yeah. No, not really. I mean, that doesn't resonate with me that much. I think what I was thinking more was, you know, maybe we want to select a stock for investment. And so we want to compare two and see which one's better. But I think there's also an element of value, as you say, in understanding what the normal levels of these ratios are in an industry, and then comparing a company within the industry to that to see whether they're in line or out of line with the industry. There's certainly value in that. Okay. Another reason would be to look at a company's ratios over time. Okay. Give me a second here, guys. I just want to close my window. These guys, like with the leaf blowers, are driving me absolutely insane. Anyone wants a startup idea? Electric leaf blowers. Why is no one doing it? Why? It's just
a good idea.
It's just a Dyson, right? It's like a Dyson, you know. Comparing a company over time. Okay, so we take the gross profit margin of a company. Okay, if it gets better over time, then the company's becoming more profitable. That's meaningful to us. Okay, it's good to know. Okay, guys, how do we classify the ratios? Okay, essentially, ratios are split into these categories that focus in on different elements of the company. Okay, firstly, we've got activity ratios, which basically measure operating characteristics of the company, like how's the company running their operations, how efficiently are they collecting cash, how much inventory are they sitting on? Because, you know, as we said, increase in inventory means cash goes out the company. So we don't want to necessarily do that. We want to make sure that we have only the amount of inventory that we need for our business plan. So how's the company operating? Okay, activity. Okay, then liquidity. Okay, liquidity is how is a company able to pay their expenses on a short-term basis, on a month-to-month basis, pay their salaries, pay their accounts payable. What's their ability to do that, and how is that ability changing over time? It's especially relevant to credit analysis, okay? Because of a company, you know, this happens to companies all the time. They're great companies, they've got high margins, but they run out of cash and then they go bust because they can't pay their suppliers. So that's really important, okay? Especially when you're doing turnarounds, which I've done turnarounds. This is really this is your lifeblood. Cash is your lifeblood when you're running a business. Any questions on activity or liquidity ratios? No. Solvency ratio. Solvency basically looks at the long-term debt structure of the business. So last week we talked about buying a house with a $500,000 house with 100,000 down and a 400,000 mortgage. Okay, that is basically a 20%. 20% of that is financed by equity and 80% is financed by debt. Okay, you could do it a different way. If you're a rich guy and you've got a lot of cash, you could put 250,000 down cash, right? Then it's 50-50. Why is it important? Well, what happens if you lose your job? okay, and you've got the 400 mortgage. It's much worse than if you've got the 250 mortgage, right? Because you can't make the payments. That's what solvency is about. It's about looking at a company and saying, okay, how much debt has this company got effectively, okay? Debt can also be a good thing, okay? Debt can also be a good thing. You know, if you've got a company that's growing, you know, if you acquire a company that's growing with debt, then the amount of money that you actually have to put down as an equity investor is smaller relative to the cash flows of the company, okay, then it would be if you had to put the whole amount down as an investment. Okay, that's also the kind of leverage. Okay, the profitability, I think we discussed that a bit. You know, is the company profitable? I think everyone knows what that means, right? It's kind of intuitive. Okay, and then valuation ratios, okay? We're not going to spend a lot of time on valuation ratios. We're going to do valuation separately. Right. Any questions on that?
So solvency is the ability for the company to pay off its debt?
That's what they say here, but it's the ratios that you actually calculate under that section are things like debt equity or debt to assets. Those are really more, they will tell you that, right? They'll tell you how much debt have you got, but they also tell you just, you might want to know that just for other reasons. And not only for their ability to pay off their debt. Like I was trying to say earlier, like sometimes having leverage is good, like having debt allows you to be tax efficient and stuff like that. So you may just want to know for other reasons. But it's basically the assets of the company. How are they financed? And not the accounts, not the inventory, the account, it does include that, but we're more thinking about the capital assets, the buildings, the machinery, the vehicles. How's that stuff financed? Okay. 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 Good. So let's jump into it. Okay. So now let's see here. Let's see if I can get this. Make this a bit bigger. Okay, good. Let's talk a little bit about these activity ratios. Okay, what is inventory turnover ratio? Okay, so we've got inventory and we're selling inventory. And the question is, how many times per year are we selling the amount of inventory that we have? Okay, and generally, the more the better, because if you're selling your inventory quickly, it means you're generating a lot of sales relative to your investment in the inventory. Because remember, inventory is, you know, when you buy inventory, you have to pay cash. Okay, so inventory turnover ratio. Okay, the formula is cost of sales. Okay, which we've been calling cost of inventory expense. I don't even know what they actually call it in America. When I started studying accounting, it was called cost of sales. And then they changed it to cost of inventory expense. You know, these accountants, they've got to come up with these random things in order to justify their existence. So now it's called cost of inventory expense. Okay, cost of inventory expense divided by average inventory, right? Kind of just makes sense to me. I mean, does anyone have, like, why is it average inventory? because remember the income statement is over a period of time. Income statement is a flow variable over a period of time, but the balance sheet is a point in time. Okay, so we want to compare like apples with apples on the numerator and the denominator. Okay, so inventory turnover ratio is cost of sales divided by average inventory. Okay, so let's do it. Cost of sales, income statement. Wow, that's annoying. Can't like, okay. Okay. Cost of inventory expense divided by average inventory. Where's inventory? It's in the balance sheet. Okay, so that I screwed up because that was supposed to be year one. Okay. Sorry about this, guys. Okay, so year one, cost of inventory expense divided by average. Okay, now it's going to be the average of the beginning of the period and the end of the period. Okay, beginning of the period and the end of the period. So this income statement was year one income statement, covered the year one. So it's going to be these two. Okay. By the way, I forgot to mention I made up these numbers for year zero. Okay. Let's do the same for year two. Okay. Okay, one more thing. Okay. Another way to express it is, okay, so what does this mean? It means that almost twice a year, we are selling our inventory. So let's have a look at it, okay? If we look at the income statement, we have cost of inventory expense is, in the first year, it's 2.25 million, whatever it is, 2,250, okay? 2250. And if we look at our average inventory, it's going to be the average of those. So the average of those is 2350. Okay. Is this right? Eh? Oh, that's sum, not average. Okay, I got it. Okay, so the average of our average inventory is around 1,000, and our cost of inventory expense is around 2,000. Okay, so what it means is that literally twice a year we're selling all our inventory. Of course, it doesn't happen like that because we're buying and selling inventory throughout the year, but that's what it means. Okay. The following year, we started selling our inventory more quickly. We sold our inventory 2.35 times. Okay. Now, the other way to express it is to say, okay, so if we sold our inventory 1.91 times in a year, how many days of inventory did we have on hand? And then you just go 365 divided by that one. Okay. That's days. So if we look at what happened here, we sold our inventory 1.91 times in year one. And we sold our inventory more, 2.35 times. Okay. And therefore, expressed differently, the amount of inventory, the number of days of sales. Okay, in this case, it's actually cost of sales. So then, but it's the same. The number of days of activity that the inventory we have on hand at any point in time during the year is around 6 months, somewhere between 190 days and 155 days. Okay. Questions on that?
So inventory turnover, like how you display it is as a percentage, like from the initial inventory you had, we covered it like for year one, 1.9 times.
What
Am I
it means,
understand-
what it means basically is if you look at the balance sheet, this number, okay, at the end of year one, we had 1650 of inventory. At the beginning of year one, we had 700 of inventory. And therefore, during year one, on average, we had 1,175 of inventory. Do you agree?
Yeah.
Okay. Okay. However, this number here is the amount of inventory expense related to our sales. Okay. The amount of inventory expense related to our sales. So that was our sales for the year. And that was the amount of inventory expense that we recognized on a matching basis. Okay. So if we say that on average, we had 1,175 of inventory, but the amount of inventory that we sold was 2,250, then we can say that 2,250 divided by 1,175 equals the number of times per year that we sold our inventory. Okay. And then you can change it into days of inventory that you have on hand on average at any point in the year by saying 365 divided by that. Who's seen this stuff before? Has anyone seen it? I mean, apart from the reading in a previous, Josh, you've seen it before. Anyone else? Jay, have you seen it before? No. Okay. Don't know what they're teaching you guys in finance at Georgetown. I mean, I'm shocked.
I'm just a freshman. It's coming up.
Okay. Okay, good.
Is it
Okay.
better to have a higher days inventory on hand?
No, it's worse. Can you tell me why?
Well, if it's a lower, that means you're selling more, right?
It means basically, because the issue is like, basically it means you're going to have more inventory. If you've got more days of inventory on hand, you're going to have more inventory, which is bad because it takes up cash. Okay, in reality, when you're running a business, okay, there's always a trade. So that's how, that would be the answer, right, to an academic question. But when you're running a business, there's always a trade-off between generating cash by holding less inventory and getting sales by having the product in stock when the customer wants it. So it's a balance. Okay. Okay.
I kind of have a question about that.
Yeah.
Like what you were saying, like how it's better if it's lower, but you like wouldn't want it to be too low, right? Because it wouldn't be efficient at that point.
Yeah. That's kind of
Okay.
what I was alluding to as well by saying
Yeah.
you know, what happens, and this happens when you have accountants running companies. They come in and they say, you know what, we have to generate cash here, so we have to reduce our inventory. And then, you know, the customer that only orders every 6 months, but they put a massive order in, they come 6 months and you haven't got the inventory, so they go and buy somewhere else. So yes, you're right. There's it's an optimization exercise. There is actually a kind of an academic theory about how to do it, but in practice, it's not really, you know, you just gotta work it out on a case-by-case basis. And some businesses are highly specialized in this. For example, you know, these auto parts stores.
Yeah.
These auto parts stores, they've got massive data analytics investment to be able to try to predict which stuff they have to have in stock in order to maximize their sales, but also not to there's a limit to how much you can hold, because they've got to
Yeah.
predict based on, I don't know how they do it.
Gotcha. Okay. Thank you.
Welcome. Good question. Okay. Accounts receivable turnover. Okay, what is this? This is, you know what? We'll work it out, but the accounts receivable days outstanding is more meaningful. Okay, so the turnover, it's basically the same concept as the inventory. It means how many times per year are we collecting our average accounts receivable balance? Okay. Okay. So in this time accounts receivable is generated by sales, right? Not cost of sales. So the numerator is revenue. Okay. Numerator is revenue. Denominator is average accounts receivable. Okay. So, then let's convert this into days. Exactly the same. 365 divided by that gives you the days. Okay. So what's happening with this? This here, right? If we look at the days, what does this mean? Basically, what it means is we're collecting. It takes on average in year one 40 days to get our money when we sell something. But in year two, it takes 60 days on average to get our money when we sell something. Okay. Let's go back and have a look at the cash flow statements. Okay. Can anyone see here what's happened here? Okay, I'm going to volunteer someone. Josh, what's happened here? Can you see where my cursor is? I think you're on mute. You're on mute.
Oh, sorry, down there. Let me just take a look.
Okay, I'm going to just quickly repeat the question. Okay, so
Yep.
we were looking at accounts receivable days outstanding.
Yep.
And we saw that in year one, it took us 40 days to collect our money on average.
Yep.
And in year two, it took us about 60 days to collect our money on average.
Okay.
And then I was saying, if you look at the cash flow statement, I said, what do we see happening here?
We're seeing more money being paid on receivables versus in cash.
Okay, well, yes, but what we're seeing on this line, accounts receivable, is that $1,000 additionally flowed out of the business because we had an increase in accounts receivable.
Okay.
Okay, let's go back to the balance sheet. Let's have a look. Accounts receivable. So we can see what happened here, guys. Our accounts receivable went up by $1,000. Okay, so what does it tell us? Without looking at all that, we're just looking at the ratio. We can already see it took us on average 40 days to collect our money in year what? In year two, it took us 60 days on average to collect our money. Okay, we know that's not a good thing. Okay, that's not a good thing. Okay, maybe that's, there's certain customers that are paying slower because they're in risk of going out of business. It could be that our methods, we've had a change in our accounts receivable department, and the new person that's sending out the statements and invoices is not doing it on time. But it's not a good thing, right? Because it's cash going out of the business. Okay. Any questions on that?
Question. So for receivables turnover, wouldn't the max just be like 1 because you can't receive more than like 100% of what you're supposed to receive? Does that make sense?
Uh,
Like for inventory, you can, I was thinking like you can order more inventory. That's why you can have above one for
no,
inventory
because
turnover.
no, because the numerator is sales, so that's for a year, and the denominator is inventory. But you typically don't hold like a full year's inventory. You hold just like 1 month or two. I mean, sorry, not inventory, receivables. So let's say, for example, your terms with your customers are that they pay you within 30 days of statement. Okay, so then what happens is at any point in time, typically people owe you for 30 days. In reality, it's 45 days, but let's just assume it's 30 days. So you can see that if you sold for a whole year, you've got a whole year's worth of sales, but you only owed for 45 days. So the numerator is 12 months, the denominator is 1 month.
Okay.
Okay. All right. Any other questions on receivables turnover? No questions. Okay, good. Okay, payables turnover, guys, it's the same concept. Okay, it's basically how quickly are we paying our suppliers? How quickly are we paying our suppliers? Okay, so let's see. Okay, so the numerator, okay, is purchases. Okay, where do we find purchases? Okay, purchases we find over here under accounts payable, something that's not on the face of the income statement, balance sheet, or cash flow statement. Okay, that's our purchases. Okay, divided by average. Did I spell average right there? Average. Average. Okay, accounts payable. Okay. Okay. So what does this mean? Okay, it means that we're paying our suppliers 3 times a year. I mean, is that useful? No. Okay, so 365 divided by that. Okay. This is then the number of days. Okay, the number of days on average that it takes us to pay our suppliers. Okay. So who can tell me, okay, Madison, you're being volunteered. If in year 1 we paid our suppliers on average in 114 days, so they delivered something to us, and 114 days later we paid them. In year 2, it's just around 70 days. Okay. What is happening to our cash in year 2 compared to year 1?
So our cash would be going up, right? Because we're not like in debt to those people.
No,
we're just-
no. So it's a bit counterintuitive, and this stuff you will struggle with it. It's really, so if we're paying people quicker, we've got less cash. That's the way to think about it.
Okay.
Yes, you're right. We've got less debt, so we're a better company. That's true. But because we paid them, we've got less cash.
Mm-hmm.
Okay, so we expect to see that we've got less cash because of accounts payable. So let's go have a look at our I hope I haven't screwed this up, yes, okay, so accounts payable decreased, and it sucked up $150 of cash. Okay, so don't ever pay anyone until you have to when you're in business, okay? you pay as late as you can, except if they give you a discount for paying early. And also, you know, without harming your relationship. So you pay on time, on the last day that you're allowed to. Okay. Average working capital. Oh my God, what is that? Okay. Oh, okay. So guys, remember, working capital is inventory, accounts payable, and accounts receivable. Okay. Accounts payable, okay, is a liability. Okay, inventory and accounts receivable are assets. So if we want one number that represents the overall investment in working capital, being accounts receivable and inventory and accounts payable, we need to add inventory to accounts receivable and minus accounts payable. Assets minus liabilities, and then it'll give us our net investment in working capital. Okay, just to further complicate it a bit, we're looking for an average. So we're going to take the average of each of those numbers in year 1 and year 2. Okay, but luckily we've got a spreadsheet, so that makes it a bit easier. So we just go average. Okay, average working capital. So average working capital is going to be average of those 4 minus the average age of those 2. Great. Extra, okay, there's an extra bracket. No. Average of those 2 minus the average of those 2. Okay. Oh boy, okay, let's start again. Okay, so it's going to be average of those 4 minus average of, okay, those 2. What? Can someone tell me what's going on here? Is it possible that that actually is 0? I mean, it's highly unlikely, right? Highly unlikely. Okay. Let's figure out what's going on here.
So those numbers on the left look like they're the change, aren't they?
Which one's Josh?
Well, we look at like year 1 and 2 for inventory. The inventory year 1 would be 1650, and the inventory year 2 would be 900. I'm just trying to figure this out here.
I mean, it could be, let's just see if we do it like this. So the average of that is 750. And the average of that, it's just, you know what, it's a wild coincidence. Can you believe it, guys? It's a wild coincidence. So if you look at the bottom of my screen here, okay? You see it says 750 there. It's a tiny little thing in this little average box down here. Can you guys see that, where my cursor is? Okay. And then the average of accounts payable is also 750. It's the average of 1,500. So the difference is 0. Highly improbable. Okay, but it's that. There you go. Okay. What are we trying to do here? We're trying to, instead of saying separately how many days of inventory do we have on hand? We're actually not working in days, but instead of saying how many times a year are we turning over our inventory? How many times per year are we paying our suppliers? How many times per year are we collecting our receivables? We're combining those all into one number, which represents our overall investment in working capital. And that's called working capital turnover. Guys, to be frank, I've never used this, okay? But there you have it, okay? Revenue divided by average working capital. Okay. Revenue. Okay, and of course now it's going to give us divided by naught, okay, just to add to the, okay.
So I'm just kind of curious here, Daniel.
Yeah.
Back up. So the average working capital, we took the average of the change in net working capital for, we took the change and year one.
So just, this is not a ratio, okay, average working capital.
Yeah.
This is not a ratio. So what are we doing here is, if you look at the balance sheet, we're saying working capital is inventory plus accounts receivable minus accounts payable.
Okay. Yeah.
But
Yep.
we want the average of year 0 and year 1. Or if we were working out the working capital for year 2, average working capital for year 2 would be.
Gotcha.
Yeah. Okay.
Okay. So this is year 0 essentially.
Yeah.
Down on the left hand side there. Okay.
Yeah. I don't like having errors, so I'm going to delete it. Okay. Okay, guys, fixed asset turnover. What is this? This is, it basically measures how effectively we're using our fixed assets, in this case, vehicles. Okay, how much, it's like, have you guys ever heard of sales per employee? Sales per employee is something that companies measure to show how efficient they're being, right? So the higher your sales per employee, that's supposed to be a good thing. It's kind of a similar concept. We're saying we've got some vehicles, okay, that we've invested in. What is our sales relative to those vehicles that we've got, right? How well are we using those vehicles? Okay. Francis and I at the moment are looking at a deal, okay, where this is highly relevant. Okay, the company has got big expensive assets that are expensive to purchase, and those assets are basically used to perform a service, and it's going to be expensive to get more. So we really want to know how much is it sales per fixed asset, or how much sales can we generate with each one of these expensive machines. Okay, sales is revenue, okay, divided by average. Average fixed assets, okay. In the case of this company, it's just the vehicles. Okay. Yes, so if we look at that, okay, the company is getting more efficient in using their fixed assets, because in year 2, they generated 70 cents of sales for every dollar they had invested in fixed assets. But in year 1, they only generated 50 cents in sales. Okay. Any questions on that? No questions. Okay, total asset turnover, it's the same, but it's just total assets, not just fixed assets, okay? So it's going to be revenue divided by average. Sorry, I'm not a very good speller. I've got like a bit of dyslexia. Average total assets this time, guys, total assets. There's total assets right there. So average, because remember, whenever we're comparing an income statement item to balance sheet, we want to compare apples with apples. So we take the first balance sheet and the last balance sheet of the period and compare it to the income statement for the period. Okay. Total asset turnover. Okay. Same pattern, right? Companies getting better at employing all assets, not just fixed assets. They're generating more sales, okay, per dollar of investment in total assets. Questions on that? No questions. Okay, guys, liquidity ratios. Okay, remember these ratios basically measure our ability to pay our short-term obligations, basically to pay our suppliers. And they do so by saying, what is our current liquid assets and what is our current liabilities that we have to pay in the near term? And how do they relate to one another in terms of ratios? The idea being if the business were to stop operating tomorrow, the people that owed the business money would still pay them. And the people that owed the business money, like for example, their customers, right, that they've already delivered product to, still owe the company, even though the company stopped operating. Okay, the company needs to pay its suppliers that have already delivered stuff to the company. Okay, and the question is, if the company stops operating tomorrow, would they be able to pay their suppliers? And that's what these ratios try to work out, right? Okay, so but they're different ones, okay, and they go from least conservative to most conservative, based on what do we include in current assets. Okay, so the current ratio is the most kind of forgiving. Okay, so we say all current assets, okay, regardless, okay, it's all current assets. So cash, accounts receivable plus inventory divided by, okay, all current liabilities. Okay, now, I don't know if you guys noticed, but I didn't use averages here. Okay. I just used the balance sheet numbers for year one. So I said total current assets in year one divided by total current liabilities in year one. Okay, who can tell me why I didn't use averages of year one and year two? Okay. The reason is because everything is, the numerator and the denominator are still the same. Okay, the previous examples we had to use the average because the numerator was the income statement, which is over a year, and the denominator is from the balance sheet, which is at a point in time. Now that the numerator and the denominator are both coming from the balance sheet, we don't need to do that. Okay, good. So guys, we're trying to say, look at this here, look at this balance sheet. Okay, what happens if the company stops operating tomorrow? Okay, there's no more sales, but okay, we've got a little bit of cash. Okay, we've got a bit of inventory, which maybe can still be sold. We've got a bit of accounts receivable. People owe us that money for product we've already delivered. Okay, they're going to pay us that money. They have to pay us. Okay, we owe our suppliers $500. Okay, so I think, look, it looks like we're in pretty good shape here. We can basically almost pay our suppliers in cash. And we'll still get paid this 150. And then we'll be able to sell, potentially some of this inventory. So it looks like we're in good shape. Okay. That's what the current ratio is. Okay. And then let's see. Damn it. Josh, get out of my cell. Okay. Okay, and then guys, so it goes up to 6. That's good. That's it means that we're even more able to pay our short-term obligations in year 2 than we were in year 1. Okay, now, like I was saying, we've got the 3 different types, which become more and more conservative. Because what's the problem? Problem is, like, let's say, for example, that the company stops trading tomorrow. They've got their cash, yes. Okay. People that owe them money for accounts receivable are going to pay because it's a legal obligation. However, the inventory, okay, they may not be able to sell the inventory. Okay, so we have a more conservative version of the liquidity ratio, which is called the quick ratio. Quick ratio is the same as the first one we did, except it excludes inventory from current assets because it's more conservative. Okay, so quick ratio. So we're just taking now cash plus receivables, so we're leaving out inventory, and we're dividing that by accounts payable. Okay, we can see it's a lower number, right? It's a lower number because we're leaving out the inventory. But still, okay, just looking at accounts receivable and cash, it's still in year 1, 1.3 times the amount of the payable. So we're still in good shape. Even if we're a bit more conservative and we say, look, the inventory, we're not going to include it. We may not be able to sell it. Okay, most conservative is the cash ratio. In this one, we only include cash in the numerator. Okay. So now it's just cash divided by accounts payable. If there were other current liabilities, then it would be those 2, but we've only got accounts payable. Okay, so now you can see it's getting a bit sketchy here. Okay. And in fact, in year 2, you know, if we'd be in trouble, like if we stopped trading, we wouldn't be able to pay our suppliers in cash unless we also collected our accounts receivable. Okay, good times. Boom, liquidity ratios. Any questions on that, guys?
Question. So why wouldn't we include the long-term liabilities? Because
go ahead.
Like if we're assuming like this is what we'll receive if like the business shut down, we still have to pay like the car loans.
Yeah, that's right. Yeah, good question. So what it should be, okay, so there should be a portion of that included in current liabilities, which would be the payment, the current payment that we have to make on that loan, but we didn't do it. So we should have said the amount of that loan that we have to pay in the next month should have been included in the accounts as a separate category of current liability. Okay, so we should have had accounts payable, and then underneath we should have had short-term portion of long-term debt. It's usually called.
So
okay.
The payments for the loan are included in the accounts payable?
We just didn't do it. We just didn't do it. Oh. We didn't do it. We assumed that there's no, we didn't do it. It's not included. It should be a separate line on the balance sheet. So it should be, you see here current liabilities. Okay. I'm not going to actually do it, but there should be another line here underneath accounts payable called short-term portion of long-term liabilities. Okay. And then it would be included in all those ratios that we calculated. Okay. Good catch. Okay. So the cash conversion cycle, guys, it basically measures how long does it take us to convert our sales into cash. And it's the sum of our days of inventory on hand our accounts receivable collection period, which is this one here. It's a different name, also called accounts receivable collection period, minus how long it takes us to pay our accounts payable. Okay, cash conversion cycle, okay, is that plus that, plus that, that plus that minus that. Okay, so what does this mean? It means basically on average, it takes us that many days to turn all of our activities into cash. If you can find a business that's got a negative, by the way, if you can find a business that's got a negative working capital cycle, it's really great, because when you scale a business, you have to invest money into inventory and accounts receivable. But if the business has a negative working capital cycle, then even when you're scaling, it's generating cash. Again, and a great example of that is like an e-commerce business typically, because your customers pay cash in e-commerce, right? Consumers pay cash, or they pay on credit cards. They don't pay on account. But you pay your suppliers 60 days later, 30 days later. Okay, so that's great, because it's a cash generative business because it has a negative working capital cycle. Okay, that's like gold. It's like gold. Okay. I'll tell you guys a crazy story. So I did a turnaround of a business, and the business basically, it had couple of different processes. So they bought raw materials, and then they mixed raw materials into compound, and then they manufactured product out of the compound. The business's machinery was in such a bad state because it was a turnaround, it had no cash, that the quality of the mixed compound coming out of the mixing department was very poor. So what I did was I found a company that could supply the mixed compound, and I started buying the mixed compound instead of buying the raw materials. And I shut down and I laid the guys off. It was painful, but the company wouldn't have survived. Okay. What I didn't realize was that not having enough mixed compound was a huge bottleneck in the production department. And so as soon as we were able to buy unlimited amount of mixed compound, these guys, I mean, the revenue and the production just doubled overnight, which was fantastic, right? And that was the beginning of working on it. But what I didn't realize, though, is just how much money we would owe this company we were buying the mixed compound, because I didn't realize the production would double overnight. And so all of a sudden we owed these guys like 3 times as much as we could pay. Okay. It's not a good place to be. I had to go and sit down with the guy and say, look, you know, I'm really sorry. I'm very sorry, but we're going to pay you off. And we paid him off. You know, it took us a year to pay him off. But these are the kind of problems that you run into if you don't keep an eye on your working capital. Okay, guys, solvency ratios. We talked a little bit about this earlier. Daniel was asking, you know, what are some of the other reasons why we may want to know these things other than just what is our ability to pay our long-term obligations? And they are, you know, the other reason you want to know is just because is the, you know, what's the leverage that the business has? Okay, so debt to assets. Okay, total debt divided by total assets. Okay. So this company, so when we talk about debt, generally we're talking about interest-bearing debt. Okay, so accounts payable is a type of debt, but generally we don't include that here. We're talking about debt that we pay interest on. Okay, so that's our term loan, okay? Divided by our total assets, which is here. Okay. Okay, Madison, what does this mean? Debt to assets.
So would that mean like how many I don't know. How many times
Okay.
a year that your debt would become? I don't know.
Yeah, this is like how your assets are financed. So you know, the example of our house that we bought with a mortgage, and we put 100,000 down and 400,000 mortgage, then our debt to assets would be 1 out of 5 or 20%. But if we put 250,000 down and we had a 250,000 mortgage, then our debt to assets would be 250 out of 5 would be 0.5. Okay. Debt to equity, okay, it's very similar, but the denominator is not the total pie, it's the other piece of the pie. Okay, so if in the case of our house, we put 100,000 down, 400,000 of debt. Okay, debt to equity would be 1 divided by 4, not 1 divided by 5. Okay, debt to equity. Divided by equity, okay, total equity. Okay. Interest coverage ratio, what is that? That's our ability to pay our interest payments, okay? Is that on here somewhere? Okay, so guys, you have to pay a fixed amount of interest, or you have to pay an amount of interest. You want to know, more specifically, the bank wants to know, how much money are you generating relative to that interest payment? Because they want to know, like, if things get a little worse, are you still going to be able to pay the interest? Okay, so the way that it's calculated is earnings before interest and tax divided by interest payments. Okay, those are both income statement numbers. Okay, this is earnings before interest and tax. It's called operating profit, but you can see that it's the only two things that get minused off after that is interest and tax. Okay, divided by interest. There. Okay, guys, so what does this mean? Okay, what it means is that we are generating 1.3 times, okay, the amount of interest that we have to pay. Said differently, our margin of safety is, you know, roughly 30% or 29%. Things get like 29% worse, we can't pay our interest. I mean, not 29, you know, 30, 31. Okay, another way to do it, you know what, I'm going to switch these around. So debt service coverage ratio, okay, similar to interest coverage, but it looks at, and this is the one that the banks actually use, okay. This basically looks at the total debt payments, not just the interest, so the interest and capital. Okay, so it looks at EBITDA, okay, divided by the actual debt payment, including interest and capital. Okay, where's EBITDA? EBITDA divided by Okay, where's our debt payments? Our total debt payments, that was the 750. Divided by that. Okay, we're not looking too good on here. Okay, we're not even generating enough to make that full payment in year one. Okay, bank's not going to like that. The banks that I deal with for the stuff that I'm working on, these like leveraged buyouts, they want to see 1.5. Okay, EBITDA should be at least 1.5 your full payment, including the capital and the interest in the base case. So not in the optimistic scenario, but just kind of the business keeps doing what it's doing. EBITDA must be 1.5 times. Another ratio, debt to EBITDA. Okay. So now we're looking at a balance sheet number divided by an income statement number. So we have to use averages for average. Okay, average debt. Again, guys, interest-bearing debt. Okay. Average interest-bearing debt. It's going to be that. Average of that. Okay, divided by EBITDA. Okay, guys, investment banking, leveraged buyouts. This is the key number. What did I just do? Average, okay. There, 7 times. Okay, this company is like highly leveraged. You see that I just know that, right? I wouldn't even need to know more. But just seeing this number, I know the company. And that's the point of this ratio, is that all the bankers use it. That's why it's useful to know. So it's good to know that, debt to EBITDA of like around 8 times is just too much. It's just like an industry norm. Okay. That's really what I wanted to get through on ratio analysis. And before we break, I wanted to have a look at some real world examples. But before we do that, I just wanted to stop and ask for questions.
I have a couple questions. So could you explain what the last two that we worked out were, like, represent, the debt service coverage ratio and the debt to EBITDA?
Okay. Debt service coverage ratio is very similar to interest coverage, but it's worked out slightly differently. So instead of being earnings before interest and tax divided, so interest coverage ratio is earnings before interest and tax divided by the interest payment. Okay, this one here that they've given you here.
Mm-hmm.
The one that I've given you here is the one the banks actually use, which is they don't really care too much about interest payment. They care about total debt payment, which includes, remember from our little debt recon, it includes the interest and the capital portion. So we paid in any particular year, or in this particular year, 350 of interest, 400 of capital. In total, we paid 750. The banks are actually interested in what's your ability to pay that 750. Okay, so the denominator is 750, the numerator is EBITDA. Okay. Debt to EBITDA is just exactly what it says. Okay, it's not a very, like in itself, not a very intuitive or meaningful number, but it's just something as an industry convention that bankers and M&A people just use, and therefore people know like what are normal for these numbers. So if the number is like 7 or 8, it's very, very high. And they sometimes call it turns of debt. 1 turn, 2 turns, 3 turns. This one is like 8 turns.
And then for debt to assets and debt to equity, it's good that's going down, right?
Yes, it's good
So
in the
that's
sense it's good in the sense of you less likely to go bankrupt. Okay, you're less likely, but like I was saying before, sometimes it's good to have debt because as long as you're not going to go bankrupt, it reduces your tax liability, reduces how much tax you have to pay. So there's an optimal point, but we're not going to get into that. That's a whole different section of corporate finance.
Sorry, I'm gonna miss it. What's a good debt to EBITDA ratio?
Like I said, I mean, it depends, right? Like I would say for an acquisition, like 3 times. There are those that would say 5 times. It just makes it more risky, but again, it'll allow you to deduct more debt.
Yeah.
When things go bad, they go bad, like, so. Guys, can we take a 3-minute break and then come back?
Sounds good.
Just a body break, okay. Good. Dagger, are you back in Berkeley now, or are you still in LA?
Going back this weekend. Actually, probably tomorrow.
Are you flying?
No, we're driving up.
Oh, good.
We can't risk flights.
I've been so lucky, man. I've been flying all over the place.
Recently?
Yeah, I flew to South Africa for family obligations, and then I flew up to Portland to be with my sister. So,
Yeah.
Not ideal.
So you have to wear like a face mask, right? Like the plastic shields.
You don't have to, but I think, yeah, it's good. Like the more protection, the better.
Yeah.
Okay, guys, let's kick off. I just wanted to spend the last couple of minutes looking at some real world examples of ratio analysis, okay? Just sharing my screen here. Okay. Can you guys see this? Okay, so what we're looking at here is, this is the stock of Johnson Controls, okay? Johnson Controls is a building automation company. They do like smart controls for buildings, like control systems for commercial buildings that controls like the HVAC system, all kinds of stuff. And then so we've got the various of the ratios that we've been looking at, okay, over a period of time, over some different years. Okay, so first let's take a look at their days of inventory. Okay, so if we start off at 2016, we can see that Johnson Controls had 63 days of inventory. Okay, they've brought it down, right? They brought it down to 44. That's great, right? That's a great job. As long as they manage to maintain their sales, but investing less in inventory, okay, that's good job, Johnson Controls. Okay. Days sales outstanding. Okay, so remember, this is how long does it take them to get paid? Okay, after they sell a product or render a service. Okay. Okay, what are we seeing here, guys?
Good, right? Because it's taking them less time to get paid.
Yeah. Still, it's quite long though, like 3 months. But I guess, if they're doing like big building projects, they maybe get paid like only after the project's completed. Okay. How long is it taking them to pay their suppliers? Kind of, just under, 80 days. Just under 80 days. Okay. They're paying them quicker. Okay. I don't really have any comments on that. Okay, then let's look at their quick ratio. If you guys remember quick ratio was the middle conservative solvency ratio, where it was accounts receivable plus cash divided by accounts payable, but it doesn't include inventory because inventory is the least liquid. Okay, so it's actually going up. It's kind of trending up. Okay, it's good. I mean, it means that they will, if they shut down tomorrow, they're going to be able to pay their suppliers from their accounts receivable and cash. Okay. Good job, Johnson Controls. Okay. Okay, guys, just a quick thing I forgot to mention, okay? Gross profit, right? Does everyone know what gross profit is? Gross profit is sales minus cost of inventory expense. That's your gross profit, right? That's typically the the profit measure that's kind of highest up on the income statement. So it's sales minus the cost of inventory is gross profit. And it kind of represents whether you're in a good business or not. Then you've got all these other kind of costs which have got to do with your administration and overhead. Those to an extent are controllable, depends. You know, are you going to put your factory in the United States or Mexico? Okay, if it's in Mexico, it's going to be cheaper. Your SG&A costs are going to be lower. Okay, but it doesn't change the fact that you're selling something, you know, for $1 and it costs you like 50 cents, or you're selling it for $1 and it costs you 80 cents, excluding those administration costs, which is the core of your business. That's gross profits, okay? After you minused off SG&A, okay, operating profit. Okay, and the net profit is the bottom one. Okay, so it's going to be the smallest. Okay, so let's go back to Johnson Controls. Okay, so what's happening with Johnson Controls gross profit? It's trending up, right? That's great. So they are slowly being able to charge slightly more, okay, for these building controls relative to what it costs them to buy the components from China, assemble them, etc. Right? So that's good. Johnson Controls, good job. Okay. However, okay, when you get to the bottom of their income statement, you see that their net profit margin is going down. So they're earning more, the difference, you know, from what they're selling relative to the cost of the components that they bought. But somewhere along the further down in the income statement, the SG&A, the overheads, the rent, okay, the office salaries, it's going down, right? They're earning less. In fact, they're only earning 2%, 3%. Like, why even bother? Sell something for $100, you make $3. Why bother, right? Okay, so then let's dig into it a little bit more. Let's look at their leverage, okay? This is their debt to assets. How much debt have they got relative to their assets? 22%, okay? So that's kind of close to the inverse of our house example. So in our house example, we put down 100,000, we had a 400,000 of mortgage. These guys have got 400, they put down 400,000, they've got 100,000 of mortgage. So the debt to assets is around 22%. Okay. Was trending down, now it's gone up a bit, okay? Maybe they decided, look, the interest rates are so low, let's take some additional loans. Okay, then let's go have a look, see. This is, okay, so so the question, you know, so from looking at this, the picture that I'm getting is that somewhere in the income statement, the expenses are going up beyond their gross profit, right? So below the gross profit, something's eating up the profit. And I think it seems like they're taking on more debt, right? They're taking on more debt, slightly. They've been up from 70% to 22%. So then we go and we pull what is their interest expense, and we see, yes, it is kind of going up, like around an extra 50 million. Okay. The reason that I don't know why these lines are like they are, but they spent an extra 50 million on paying debt interest, right? Compared to the previous year, extra 51 million. So that could be a contributing factor to why they've got a high gross profit margin, but a very low net profit margin. Could be that they're paying more interest. Okay. All right. Okay. Now what we're looking at, guys, on the right here, we've got another company. This company is Honeywell. Okay. Honeywell is a much, much bigger company, and it's more diversified. So they do the building controls, but they also do other stuff. Okay. So now we're looking at Honeywell. And here's their numbers, right? But it's most useful to look at them side by side and to compare the numbers. So let's see. Okay, days of inventory. Okay, Johnson Controls, 44 days of inventory on hand. Honeywell, 70. Honeywell have got almost twice the amount of inventory on hand. Okay, that's not good, right? That sucks up cash. Okay, days of sales outstanding. Honeywell's at 75 days. Johnson Controls is at 86 days. Okay, so Johnson Controls takes a lot longer to get paid. Okay, so that's bad Johnson Controls. Okay. How long does it take Honeywell to pay their suppliers? 3 months. Johnson Controls pays them quicker. Okay, the quick ratios are about the same. They're both, pretty close to 1. Okay, now this is the important bit, guys. This is the important bit. The gross profit, okay, at Honeywell is 38%. It's almost 39%. Johnson is only earning 33. Means that Johnson and Honeywell, okay, so Johnson is a big diversified company. Honeywell's a big diversified company. Johnson only does the building automation. Whatever else Honeywell's doing, they're making more money doing that, and they've got a higher gross profit. Most likely. That's most likely the explanation. Okay, even more impressive, okay? Honeywell's net profit margin is 16.7%. Okay, that's the bottom of the income statement. So for every $100 they sell, they make $17 almost. Okay, whereas Johnson only make like $3. Okay, so Honeywell, much more profitable company. Much more profitable. Okay, the capital structures are quite similar. Okay, Honeywell has more leverage, but maybe because they're diversified, they can afford to have more leverage because they're less exposed to any particular industry. Okay, so then let's say, like, what does the market say? Okay, what does the market say? Let's look at the price earnings ratio. Price earnings ratio is the ratio of a price of a stock relative to the net profit that stock earns. Okay, Johnson is around 60. Let me just open this up here.
Could you say that again?
Price earnings ratio. Price of a stock divided by net profit of a stock. So it's kind of saying, how many years worth of profit am I willing to pay for a stock in this company? For a share of stock in this company. Okay, and the answer in Johnson Controls is 60 years. Okay. So the investors are saying, I will buy a share of stock in this company at a price that equals 60 years of profit. Okay, sounds pretty insane, eh? Doesn't that sound insane? I mean, who knows what the world's going to look like in 60 years? I mean, I'm not even going to be around in 60 years, most likely. Almost definitely. Okay. The PE ratio of Honeywell, okay? It's only 30. Half, right? So investors are saying, I will pay a price for a share of stock in Honeywell, but I'm only prepared to pay 30 years of earnings. Okay, half. Why is this, guys? What's going on here? Okay, I'll tell you what's going on. Johnson Controls is a high growth company, okay? It's in a sector that the investors love, which is this IoT and building automation. It's an exclusive play on that, and it's a high growth company, okay? It's growing quickly. Its revenue is growing quickly. Johnson is, Honeywell's more of like a kind of seen as like a more like old school, boring company. Okay, and for that reason, people just are not that excited about it. Okay, so now the question becomes, if investors are willing to pay 60 times, 60 years of earnings, okay, for Johnson, and they're only willing to pay 30 years of earnings for Honeywell. And the reason is because Johnson is a high growth company. Okay, how might we normalize those two measures? Okay, and the answer is we divide by the company's growth rate. So the ratio is price to earnings, but then we divide it by the growth rate, right? Divided by the growth rate. It's called the PEG, or PEG ratio, price earnings to growth. Okay, and the idea is people are willing to pay more for a high growth company, so you expect them to have a higher PE ratio, but not so high that it outweighs the higher growth rate. Okay, so let's look up the PE, the PEG ratios for these companies, okay? PEG ratio. Okay. Okay, so the PEG ratio, PE to growth for Johnson is 0.9. Hang on a sec, guys. PEG ratio. And I'm going to finish after this. We're almost done. Okay, so the PEG ratio is 0.9, which is the ratio of the PE ratio to the growth rate. And these guys over here, okay, minus 3.3. Okay, they must have a negative growth rate, because we know the PE ratio is positive 30, so it must be a negative growth rate. So, okay, so there you go. It makes sense, right? That's why the market is not too excited. Okay, one last thing, guys, before we break. One last thing. PE ratio, okay? It's the ratio of the price of the share to the earnings, but it's the past earnings. We may be interested in the predicted future year of earnings. So there's lots of analysts, stock analysts, that go over and they predict what the company is going to earn. And then, you know, people like Bloomberg get together and they average all those analysts' predictions. And they say, this is the expected, or no, you know, I'm not sure if that's the number that's in this program, but also management will give guidance. So we have a future earnings. And so if we look at the ratio of the price of the stock of share to the future, to next year's earnings, It gives us more relevant information because last year is the past. Okay, so let's look those up. Okay, price earnings, forward price earnings ratio. Okay, annual. Okay, I'm gonna have to take some of this. It's now, I think I've forward PE. Here's their forward PE. These guys, financials, price, forward PE. Okay, now, okay, look at this. Okay, now we can see. Okay, so if we look at the forward PE ratios, they're almost identical. So using the past year of earnings, it looks illogical that the market is willing to pay twice for a share in Johnson what they are in Honeywell. But if we look at the next year of earnings prediction, then the market is willing to pay almost the same ratio. Okay, guys, that's basically what I wanted to go over for today. I know we're over time now, so if anyone has questions, I'm happy to stay on for a bit and chat. But also anyone that has other commitments and stuff is welcome to drop off.
Can I ask a question?
Yeah.
So looking at the forward PE ratio,
Yep.
Are we expecting Johnson to decrease their share price? Because can we assume like it's overvalued?
Why?
Well, in comparison to Honeywell, like the investors were willing to pay for 60 years of earnings for one share.
Yeah, but remember, that's the trailing. When you just say price earnings ratio, it means the past one. If you want to use the future one, you always have to say forward. So if you just say price earnings, by default, it means the past. So I think your question is that 60 versus 30, does that mean that the company is overvalued? And I would say yes, it's definitely an indicator that the one is undervalued compared to the other. But it's not the full answer. You've got to understand why. Why is the market that? And I said that the reason is probably because Johnson is a high growth company that's focused in this IoT segment, whereas Honeywell's diversified and they've got good, high growth, and they also do like aircraft engines and various things that the market doesn't like. So you've got to make up your mind. But on its own, it draws your attention to the fact that maybe Honeywell's undervalued. Certainly for me, I like the profit margin of Honeywell.
And then for the growth ratio that's used for the price to earnings growth, is that just determined by like revenue, or is it different for
the growth? Yeah, I think it's revenue growth. Yeah.
So what would be the formula for the price to earnings growth?
Formula for price to earnings is going to be just net income for the prior 12 months. Sorry, the share price divided by the net income for the prior 12 months. And there are in the readings, there's a section on this further down. Section on valuation ratios somewhere in here. Valuation ratios, here we go. Section 5.1. So this would be the price earnings here. Josh, what do you, I saw you sent me an email to ask the ratio analysis PDF.
Yeah, I found it. No worries about that.
Okay.
Yeah.
Guys, also the session's going to be recorded, so I'll send you a link to that.
Awesome. Actually, I did have one question just about
Yeah.
TradingView, actually. Is that the paid version of TradingView?
It is, but I think even with the free version, you can get a certain number of indicators of financial indicators. I mean, as opposed to technical indicators.
Right. And can you overlay the two graphs for ratios? Just general question.
Let me just try to find the chart. So what do you want to do?
Like put essentially like say we take like days inventory or something and just kind of overlap them for one company to another.
Oh, from one company to the other. I don't think you can without writing a script. You see at the bottom here it says Pine Editor.
Okay.
So you'd have to write a script.
Okay, fair enough.
You can combine them within one chart, within one stock ticker by going, you right click and you go move charts, remove indicators. Oh shit. Move to add indicator strategy on. So you go, yeah, you'd look up something else. You can do it, but it's a schlep.
Okay, no worries.
Oh.
Figured I'd ask.
Good. So guys, how are things going otherwise?
Good for me. What was you guys?
Yeah, I'd say they're also going good. Learned a lot today. I definitely was easier for me to grasp the financial statements and all that last week, but this was a little more. I feel like it was because it was like building on last week. So yeah, but it's good.
Yeah, I remember when I studied this stuff too, I found the ratio analysis a little more intuitive than the basic accounting. Basic accounting is just, you expect it to be intuitive because from the outside, like accounting seems like something that would be logical, but it's just not, right?
Yeah, it's taken me a while as well. Like I've learned about like ratio analysis several times, like since high school. And even still, like some of them I don't even know about. Like I'm gonna ask you actually, here's a question. The cash ratio.
Mm-hmm.
When's that used? Because usually it'd be negative, no?
It would usually be negative, yeah. I never use it. Use it. In fact, most of these I never really use.
Yeah. Okay.
But
it's usually like multiples, I guess.
Yeah, I think I take shortcuts. So if you're building a financial model, right, and you're trying to predict what a company looks like in the future, you need to know like what's their inventory, accounts receivable, and accounts payable relative to their sales.
Okay.
So the right way to do it is to work out these ratios and then to project the ratios forward and then to use the ratio projection to project the actual numbers. But the shortcut way is just to take the ratio, just make it like accounts payable, sales divided by accounts receivable is like a ratio, and then just multiply the next year's sales by that without even understanding what you're doing. But the point is to sound like like you kind of got some kind of background in education and the stuff. You've got to talk in the right terms.
Yeah, and definitely, like, even from like I said, we did this in high school and we didn't know anything about them. We just kind of knew a little bit about balance sheets and income statements and stuff. But I know now that I've actually like dove a lot kind of deeper into like the financial stuff, like going back to this actually, like, I don't know, helps, I guess. Like helps understand the greater picture, like, in a sense.
A quick question from me. So Josh and Danger, you guys have both got emails sitting in the drafts, right?
Yep.
And I don't think it makes sense to send them out on Friday afternoon.
Mhm.
So
I scheduled all mine for Monday at 8 a.m.
How about you, Danger?
Yeah, I sent you a message yesterday that I'm planning to schedule them for Monday morning.
Okay, good. Sorry, I might have missed that. I've been super busy. Okay, bye, Madison. Thank you. That's good. That's good. Yeah, I think Monday. Well, people are a bit busy on Monday, but let's see.
I can schedule it for another day. Again, they're not sent out yet, so.
I don't know. Let's just give it a shot.
Okay.
And Jay, how are you getting along?
Pretty good. I have at least, I'm working in a separate Excel thing, so I can just copy and paste it in.
Are you waiting for me for anything? Sometimes you have to prod me when I get too busy and forget things.
No, you just had me do the 20 to 30 of the companies, just get the data and emails down on them, and then you'd show me the CRM next week, you said.
Yeah. So Jay is working with us to build relationships with CPAs and investment advisors, so that when their clients want to sell their businesses, they refer them over to us.
That's awesome.
And he wants to learn about being his kind of like salesmanship skills. So Jay, you're going to have to convince these CPAs.
Yeah.
But I'll do it with you.
Yeah. I saw your video you sent. Yeah.
I just found that video. I don't know. These guys somehow got hold of my email address and they've just been spamming me.
Mm-hmm.
So should be
That's
fun.
awesome.
Yeah. Any plans for the weekend? Interesting plans. Long weekend, MLK Day. Do you celebrate that, Josh, up in Canada or no?
I don't think it's a long weekend for us, unfortunately.
Okay.
Just the 2 days. That's not even enough.
Yeah.
Yeah.
Yeah. In fact, guys, maybe we do want to delay those messages until Tuesday, given it's MLK Day.
Sure. Yeah, I can do that.
Yeah. I forgot. Good. Okay. Well, safe travels up to Berkeley, Danger.
Thank you. Thank
Yeah. Careful on the roads.
Really
and that's
busy.
it.
For MLK weekend. People are
I'm
traveling.
doing another chapter this weekend of like a securities course up in Canada. And so the chapter that I'm going to be doing this weekend is on technical and fundamental analysis, which is pretty cool.
Hey, so you can teach next week's class.
Okay. you probably know a little bit more than I do. So
No, I wouldn't say. In some areas, maybe.
I would.
Thank you. Okay, gentlemen, I'm going to sign off then.
Yeah,
right, sounds good.
Thanks. Me
If
too.
you guys have any other questions, just send me an email.
Sounds good.
Okay,
Take
bye.
care.
Have a good
Thanks.
one.
Bye.
Yeah, you too.
Bye.
Take care.